Jake buys whole life insurance. Marcus buys term insurance and invests the difference. They both protect their families for 30 years. Both think they made the responsible choice. Both believe their guy gave them straight numbers. They're both wrong, because one is paying for a death benefit he'll almost certainly never collect. And the other built a strategy that only works if he actually does the second half. And when you run the numbers through a full lifetime, premiums, cash value, surrender charges, investment returns, and what actually gets paid out, the gap between what they were sold and what they actually got will make you rethink every insurance pitch you've ever heard. Let's keep this fair. Jake and Marcus are both 30. Both earn $75,000 a year. Both married with 2 young kids. Same mortgage, same goals, same fear in the back of their minds. What happens to my family if something happens to me? They both want $500,000 in coverage. Enough to pay off the house, replace lost income for a decade, get the kids through college, and let their spouse breathe. The only difference is which product they buy. Jake sits down at his kitchen table with an insurance agent. The agent is polished, brings a binder, and spends 2 hours explaining why whole life is the smart move. It's not just insurance, Jake. It's a forced savings plan you can't lose. It builds cash value. You can borrow against it. And it covers you for your entire life, not just 30 years. Jake signs up for a $500,000 whole life policy at about $450 a month. Roughly $5,400 a year. The agent reassures him, "You're not spending it, Jake. You're building it." Marcus does something different. He buys a 30-year level term policy for the same $500,000 coverage at about $35 a month. Roughly $420 a year. No cash value, no binder, no agent at his kitchen table. Then he takes the difference. $4,980 a year he's not paying to an insurance company, and sets up an automatic transfer into a low-cost index fund. Same dollars going out the door as Jake, different destination. Jake's coworkers see his whole life policy and nod respectfully. Marcus tells people he has term insurance and gets the same question every time. But what happens when it expires? Won't you have nothing? It's the question that haunts every term buyer, and it's the question Jake's agent leans on hardest. But before we answer it, let's see what actually happens to their money. For the first few years, Jake's policy feels like a premium product. He's paying real money, he's covered for life, and his statement shows a column labeled cash value slowly ticking upward. The agent calls him every December to congratulate him on building wealth inside his policy. Jake feels like a grown-up. Marcus doesn't feel like much of anything. He's paying $35 a month for insurance he hopes he never uses, watching an index fund balance go up and down with the market. No agent calls him, no statement shows his forced savings. Just a brokerage account that requires him to keep showing up. Now the actual numbers. After 5 years, Jake has paid roughly $27,000 in premiums. His cash value, between $4,000 and $8,000. Where did the rest go? Commissions. Often 50 to 100% of his first year's premium goes straight to the salesperson. Administrative fees, mortality costs, the cost of insurance itself. The policy is structured so cash value grows slowly in the early years and accelerates later, which keeps Jake locked in. If he leaves now, he walks away from most of what he paid in. Marcus, after 5 years, has paid roughly $2,100 in term premiums and invested $24,900 into his index fund. At 7% growth, that account has grown to roughly $30,000. He has $500,000 in life insurance, same as Jake, and a brokerage account already worth nearly 4 times Jake's cash value. On every visible scoreboard, Marcus is winning. But Jake's agent has a ready answer. The early years are always slow, Jake. The real magic happens in years 15 and beyond. Technically true, but the real magic is a phrase that should make every investor's eyebrow go up. Whole life isn't a scam. It's a real financial product, regulated, with guarantees that has existed for over 100 years. But the way it's pitched at kitchen tables leaves out details that completely change the math. First, the death benefit and the cash value are not additive. This is the single most misunderstood fact about whole life. When Jake dies, his family gets $500,000, the death benefit. The cash value, the insurance company keeps it. Jake spent 30 years building a cash value of $230,000. And when he dies, that money goes back to the insurance company, not his wife. All that forced savings was a number on a statement that vanishes the moment the insurance pays out. Second, the guaranteed return on cash value is real, but slow. The illustrations Jake's agent showed him projected 6% or 7% returns, non-guaranteed projections based on dividend assumptions. The guaranteed return is typically between 2% and 4% net of internal costs. For comparison, the S&P 500 has averaged around 10% before inflation over the last century. Jake is locking in a low single-digit guaranteed return, while Marcus earns market returns. Third, surrender charges. In the first 10 to 15 years, if Jake decides to cancel, surrender charges can wipe out most of his cash value. He doesn't just lose future growth, he loses a chunk of what he already paid in. The structural lock-in that keeps people in policies they regret. Fourth, the dividend projections. Every whole life illustration shows two columns, a guaranteed column and a non-guaranteed projection that assumes the insurance company keeps paying dividends at historical rates. Agents focus on the projection, but historical dividend rates from major mutual insurers have trended downward for decades. The projection isn't a promise. It's marketing. Fifth, policy loans. Jake's agent told him he could borrow against his cash value tax-free. Technically true. What he didn't emphasize is that Jake is borrowing his own money, and the insurance company charges him 5% to 8% interest to do it. If Jake doesn't pay the loan back, it reduces his death benefit dollar for dollar. And sixth, the phantom tax. If Jake ever lapses or surrenders his policy, any gain above what he paid in premiums is taxed as ordinary income. He could walk away from a policy he's grown to regret and still owe the IRS a tax bill on a product he never even successfully cashed out. None of this makes whole life evil. It means the number on Jake's illustration is not the number Jake should be planning around. Part of it was always going to belong to the insurance company. If I only showed you the downsides of whole life, I'd be doing what every term insurance influencer does. The term and invest strategy has real limitations people love to hand-wave past. First, term insurance expires. If Marcus outlives his 30-year term, he gets nothing. No refund, no payout. His policy ends and the insurance company keeps every dollar he ever paid. For most people, this is fine, because by year 30, the family doesn't need life insurance anymore. The kids are grown, the house is paid off, the portfolio is the safety net, but that only works if Marcus actually built the portfolio. Second, renewing term in your 60s is brutally expensive. The premium Marcus paid at 30 was $35 a month. A new term policy at 60 or 65 might cost $300, $500 or more per month, and only if he can still qualify medically. Third, the entire strategy collapses if Marcus doesn't actually invest the difference. Study after study shows most people who buy term do not consistently invest the savings. They spend it. They tell themselves they'll start next month. And 20 years later, they have a term policy about to expire and no portfolio to replace it with. The strategy is mathematically superior, but only on paper. It requires real discipline. Fourth, market volatility is real. Whole life gives Jake a guaranteed, slow-growing cash value. Marcus's index fund will go up and down, sometimes dramatically. A bad sequence of returns in years 25 to 30, right when Marcus is approaching the end of his term, can dent the plan significantly. Average hides a lot of stomach-turning years. Fifth, no forced discipline. Jake's $450 a month gets pulled automatically. Marcus's $415 a month difference requires him to set up the transfer, keep it going, resist redirecting it when life gets expensive, and not panic sell when the market drops 30%. For someone who knows they won't follow through, whole life's forced contribution is genuinely valuable. Money you never see is money you don't spend. And sixth, the insurability gap. If Marcus develops a serious health condition in his 50s, he may become uninsurable. When his term ends at 60, he can't qualify for a new policy at any price. His family is exposed during years when whole life would still be in force. For the first 5 years, the gap between Jake and Marcus favors Marcus. Same coverage, more wealth, less stress. But around year 7, something interesting happens. Jake's cash value starts compounding faster. The early year drag of commissions and fees is behind him. His illustration starts to look credible, and Marcus's portfolio has to weather its first real market downturn. By year 10, Jake has paid roughly $54,000 in premiums. His cash value is now $35,000 to $45,000. Progress compared to year 5, but he's still underwater on what he paid in. Marcus's invested portfolio, with $4,980 going in every year at 7% growth, has grown to roughly $72,000. By year 15, Jake's cash value has grown to about $75,000 against $81,000 in premiums paid. Roughly break even the moment whole life policies start to actually look attractive on paper. Marcus's portfolio is at about $129,000. By year 20, Jake's cash value is around $128,000 against $108,000 in cumulative premiums. He's finally ahead. He has a death benefit of $500,000 still in force and cash value he can borrow against. Marcus's portfolio? Around $215,000. Same $500,000 death benefit. Fully liquid. No surrender charges. No loan paperwork. Both men are now in their 50s. Both have $500,000 in coverage. Jake has $128,000 he can borrow but not freely spend without consequences. Marcus has $215,000 he can do anything with. Sell tomorrow, use as a down payment, give to his kids, leave invested. The compounding gap is real and growing. This is the part Jake's agent never showed him. The illustration only showed the cash value column going up. It never showed what the same money could have done somewhere else. Fast forward to year 30. Jake and Marcus are both 60. The kids are grown. The mortgage is paid off. The original reason they bought life insurance, replacing income to protect their family, is largely behind them. Jake's whole life policy is still in force. He's paid about $162,000 in premiums over 30 years. His cash value is approximately $255,000. His death benefit is still $500,000. The policy stays in force as long as he keeps paying, which he'll need to do for the rest of his life. Marcus's 30-year term policy expires. He gets nothing from the insurance company. Zero. The paperwork goes in a drawer. But his invested portfolio, $4,980 a year at 7% average growth for 30 years, has grown to approximately $495,000. Fully liquid. Fully his. No insurance company in the middle. Now the scenarios that actually matter. Scenario 1. Jake dies at 65. His family receives the $500,000 death benefit. The cash value he spent 35 years building, the insurance company keeps it. Net benefit from the whole life strategy, $500,000 minus $162,000 in lifetime premiums, which equals $338,000 of net protection delivered. The family is fine, but the cash value never came home. Scenario 2. Marcus dies at 65. His term policy has already expired. His family receives zero from the insurance company. But they inherit his portfolio, which by then has grown to roughly $650,000. They walk away with more than Jake's family received, with no insurance company in the equation. Scenario 3. Both men live to 85. Jake's family eventually collects the $500,000 death benefit, but Jake spent the last 25 years of his life paying premiums on a policy he never personally benefited from. Total lifetime premiums, roughly $297,000. Marcus's portfolio, even with modest retirement withdrawals, is likely worth well over $1 million by 85. He spent it during his life, and his family inherits the rest. In the most common scenario, both men living a long life, Marcus's strategy delivers dramatically more wealth and more flexibility. In the worst-case early death scenario, Jake's strategy delivers more. But that scenario has roughly a 5% probability for a healthy 30-year-old over a 30-year window. Whole life is optimized for a low probability outcome. Term plus invest is optimized for the high probability outcome that you live. At age 50, life throws a curveball. Maybe it's a medical bill. Maybe a parent needs help. They both need $40,000 fast. Jake takes a policy loan against his cash value. The insurance company hands him the $40,000 and charges him 5% to 8% interest per year. He's borrowing his own money and paying interest for the privilege. If he never pays the loan back, it reduces his death benefit by $40,000 plus accrued interest. And if interest accrues too long, the loan can eat enough of the cash value that the policy lapses entirely, at which point Jake owes income tax on the gains, a loan against your own money that can blow up your entire policy if you mismanage it. Marcus sells $40,000 worth of his index fund. He pays long-term capital gains on the appreciation only, typically 15%. If his gain is $20,000, he owes about $3,000 in capital gains tax. He walks away with $37,000 net with no loan, no reduced death benefit, no policy that could blow up. He just sold his own investment. Same emergency, same dollar amount. Jake created a debt obligation to an insurance company on his own money. Marcus simply spent his own money. If I left the story here, I'd be doing what I accused the whole life salesman of doing, telling half the truth. Whole life is the right product for specific identifiable situations. First, high net worth estate planning. If your net worth approaches the federal estate tax exemption, currently around $13.6 million per individual, whole life can provide liquidity to pay estate taxes without forcing your heirs to sell the family business or the real estate portfolio. It applies to a tiny fraction of Americans, but for that fraction, it solves a problem nothing else solves as cleanly. Second, special needs family planning. If you have a child with a permanent disability who will need financial support for their entire life, you need life insurance that doesn't expire when you turn 65. Term ends. Whole life doesn't. The guaranteed lifetime death benefit is structurally necessary. Third, people with serious savings discipline problems. If you know with absolute honesty that you will not invest the difference, that the $415 a month you'd save going from whole life to term will get spent on dining out, vacations, or whatever, then the forced savings nature of whole life is genuinely valuable. A mediocre product you actually use beats a superior product you never execute on. Fourth, business owners with succession needs. Whole life is used in buy-sell agreements, key person insurance, and deferred compensation plans for executives. Legitimate business uses where the permanence and the cash value flexibility both matter. Fifth, anyone with a genuine permanent insurance need past 65. Rare, but if your dependents will continue depending on you into your 70s or 80s, a much younger spouse, specific family obligations, permanent insurance has a place. These are the legitimate use cases. They are not what most kitchen table sales pitches are aimed at. Most pitches target average middle-class families with kids and a mortgage. Exactly the wrong audience for whole life. For the vast majority of middle-class American families, the 90+% term plus invest is the right strategy. Not because it sounds clever on YouTube, because the math is overwhelming. Life insurance exists to replace your income during the years your family financially depends on you. For most people, that window is the years you have kids at home, a mortgage, and a working spouse who couldn't immediately replace your income, usually 20 to 30 years. After that, the kids are grown, the mortgage is gone, and your retirement portfolio is the safety net. Buy enough term coverage to replace your income for those critical years, typically 10 to 12 times your annual income, and invest the difference into low-cost index funds inside tax-advantaged accounts. You end up with more death benefit during the dangerous years and more wealth at the end. You don't have to choose between protecting your family and building wealth. You do both with the same dollars. By the time your term policy expires, you don't need life insurance anymore, because the portfolio you built is the insurance. If something happens to you at 65 with a $700,000 portfolio, Your spouse doesn't need a death benefit. The portfolio is the death benefit. It's just one you also got to use while you were alive. Jake and Marcus both walked away thinking they made the smart play. Jake thought whole life was the responsible move. Marcus thought term plus invest was the obvious math winner. Neither was wrong on principle, but neither had the full framework. Here's what actually works for most families. It's not a slogan, it's a sequence. Step 1, buy enough term life insurance to replace your income during the years your family needs it. For most working-age people with kids and a mortgage, that means a 20-year or 30-year level term policy with coverage equal to 10 to 12 times your annual income. If you make $75,000 a year, that's $750,000 to $900,000 of coverage. Premiums will be modest, usually $30 to $60 a month for a healthy person in their 30s. Step 2, take the difference between whole life and term premiums and invest it every single month, automatically, into low-cost index funds inside your 401k and Roth IRA first, then a regular brokerage account if you have more to invest. This is the half most term buyers skip. It's also the half that makes the entire strategy work. Step 3, so only consider permanent insurance if you have a specific, identifiable permanent need. Estate tax exposure, a special needs dependent, a business succession plan, a guaranteed insurability concern. If none of those apply, you almost certainly do not need whole life, no matter how compelling the kitchen table pitch was. The real trap isn't whole life, and it isn't term. The real trap is buying a $500 a month insurance policy from the first person who sat across your kitchen table with a binder without ever running the numbers against the alternative. The real trap is letting someone else's commission structure define your family's financial plan. So the next time someone tells you whole life is the responsible choice, or that term is the only smart move, ask them one question. Did you run the numbers for my income, my family, my timeline, and my actual goals? Because the answer that includes everything is the only answer that matters.